This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled today to be joined by Amber Walsh. Amber's a leader at the intersection of healthcare and private equity. She joins us regularly. She's from McGuireWoods, talks about trends she's watching in the deal world, the private equity world, and more. Amber, I think you're coming to us today with 6 quick bullet points, trends that you're watching. Tell us what those are. Tell us what you're seeing.
Yeah, absolutely. And really focused particularly today on healthcare private equity carve-outs as a particular deal type and M&A strategy. And what a carve-out is not your traditional sponsor-to-sponsor transaction where one sponsor sells out its equity to another sponsor. We're not talking about deals where it's first institutional capital, where you have a founder selling to a private equity sponsor, or a distressed deal. What we're talking about and what I'm really interested in today is healthcare private equity carve-outs, typically, most commonly from a very, very, very large cap mega healthcare company divesting one of its divisions or one of its assets to a private equity fund. And we really saw an uptick in that again in 2024 as everyone's kind of reporting and crunching the data from last year. And that's really been a steady uptick from 2010 in that particular type of deal, which I'm really interested in today.
Thank you. And when we see these carve-outs, we're seeing so much in the private equity world of people having a harder time exiting the sponsored deals. Like I just came across my desk, a sponsored deal where they're selling the deal, but they're selling it to another company controlled by the sponsor, and more of that, different ways to exit. When you look at the corporate carve-outs, what are you seeing there? What's going on? What's driving a lot of that activity?
Yeah, that's absolutely right. All sorts of different kinds of deal structures. But on the carve-outs, why it's so attractive is that, we've talked so much in the past 18 months or so about the challenges of getting more traditional buyout deals done, particularly requiring debt and the level of diligence involved and some instability in the regulatory markets. But yet you also had these fully funded funds with dry powder that needs to deploy capital. And so even though everyone is expecting and already seeing that loosening up and getting more active back again in 2025, what the carve-out market did was allow private equity buyers to acquire and reinvigorate assets that were considered a little more stable, often cash flow positive. They are not necessarily troublesome assets for the divesting company. It just happens that the divesting company no longer really considered that particular division or asset part of its strategic plan and vision. And so what you see is these mega companies streamlining, choosing to divest what they consider non-core assets, but they're really attractive assets for private equity buyers that are really stable and are going to perform well in diligence. And it just opened up this has been going on for, as long as there's been private equity, but again, last year saw an uptick, including in healthcare.
Thank you. And I think that's part of the point is that these are often good assets. They're just caught in a corporation or company where it's not the primary goal of that corporation or company. Is that a fair statement?
Yeah, that's absolutely right. I mean, of course, every deal has its own features, but that is quite often what it is. It's just the divestor makes a choice, and there's a whole market and these private equity funds where they've got to answer to their LPs. They need to deploy their capital. They can be very attractive. And there's a real potential for high returns, although there's some challenges to those as well, because depending on really how embedded that particular division or asset is to the rest of the company from which it is being divested, it requires the buyer to diligence in a whole new way sometimes. Sometimes it's hard to diligence when it's so core to another business line. And it also can be hard to operationalize and instantaneously kind of take over and run it as the buyer. And so a lot of times you'll need some very serious transition planning, but there's a lot of potential upside in those deals.
No, fascinating. It makes a ton of sense. And Amber, any more observations there? Because we're seeing sort of private equity that's trying to put money to work, but having a hard time hitting that exact price number between them and the sellers. And this might make a different avenue for private equity funds to put money to work, because these are deals that are not necessarily the corporation's trying to get a great price, but they're not as responsive to other investors, and they got other corporate reasons to exit the business. So it might be easier to find a price to come to agreement on price with the buyer and seller in these deals.
Yeah, that's exactly right. And I guess I'd give you just three more observations. Is within healthcare carve-outs, we definitely last year saw them in all subsectors of healthcare. So it's not just pharma and biotech, which may be the first things that come to mind, but we saw it in traditional services. We also aren't just seeing these carve-outs go to the mega private equity funds. You see it in the middle market, and you even see some lower middle market, but that becomes a little bit less common because they tend to be pretty expensive, which kind of leads me to my last point observations is some examples of these. So in the past year in services, which you know is where I kind of live and breathe, in traditional services, we saw KKR buying Eugen from Fresenius and rolling Eugen, which was Fresenius's fertility platform, into KKR's existing IVI RMA deal, and then Carlyle buying Baxter's dialysis unit and rebranding as Vantive, and that was a nearly $4 billion deal. So, you know, they're not all that expensive, but they can be pretty high dollar deals, particularly when it's a high performing asset like Baxter's dialysis unit. Just very interesting. It's a whole other interesting area of private equity M&A activity that's not the more common sponsor to sponsor or founder to sponsor.
Yeah, yes, no, and that's fascinating. And right, the founder to sponsor, the sponsor to sponsor. I mean, so much of the deal world revolves on sponsor to sponsor. Sponsors from the existing deals have a hard time getting the price they want from the new sponsors. So you've got these new ways in which new sponsors or existing sponsors have money to put to work or trying to put money to work. What a fascinating ecosystem. Amber, as always, I learned something talking to you. I appreciate it so much. I know our audience does too. Again, Amber Walsh, Executive Committee at McGuireWoods. Fantastic, Amber. Thank you very, very much.
Thank you, Scott.